All right, why don't we get started? So, thank you guys very much for joining. We're going to talk about buying and selling decisions today as part of our results season webinars. So, go through that. But first, anything you hear today is general advice. I obviously can't offer you personal advice, but I will answer questions. So, send through any questions you may have in the chat or in the Q&A. And also, if anyone's interested, we have our conference coming up in October. So it's 2 days. We have an all digital day. So as you can see, that's October 11th. And then on Thursday, we have a live day at the ICC Sydney, but that also will be available for anyone who wants to watch that online. So if you have any questions about tickets, send me an email. I can send you a link. And it'd be great to meet as many people as possible there and to have you come see the conference. I think we've got a pretty good agenda, but you can check that out online if you would like. All right, so let's get started. So we're obviously trying to put this in the context of results season, but a couple of things to think about is generally when companies are reporting earnings, you are seeing more volatility than normal in the market. And this happens for a couple of different reasons. So one thing, obviously, short-term traders are trying to profit off of these swings. And so the first thing you see is people obviously positioning themselves prior to an earnings release. With whatever they anticipate will be the results and the impact that will have on the share price. So obviously that creates some volatility. Then, of course, the share prices react once earnings are actually released. If people think that they're good or bad or something in between, we can see some swings there as well. And then also, of course, it can affect rivals. So obviously, if one of the banks reports, people can extrapolate that into what another bank will do based on the environment. And so you see a lot of positioning around that. So it can increase volatility. And one thing that's really important for us to remember as investors is that volatility in general leads to poor investor behavior. So especially during this time, we need to go back to the basics, of course, that we'll talk about today and rely on the structure that comes from having goals and an investment strategy, and then a criteria for security selection criteria. So we'll go through this. We'll go through an example, actually, of something I recently bought, which, of course, is not an endorsement for anyone to go out there and buy that themselves, but examples work well. And we have a conference question already. So Jane says, will there be a recording of the all digital day for those that cannot watch on the day? There will. So basically, we will record everything. So we'll obviously record the digital day. We'll record the live day as well and stream it during the day. And all of those recordings will be available for at least a month afterwards. So people can go back and watch those at their own leisure. So thank you for the question on the conference. And hopefully that means, Jane, that we will see you there. All right. So let's talk about sell. We'll quickly cover sell, then we'll go into buy. I thought that was a good way to go about things. So should you sell after poor results or in general? So let's go through a couple things about selling. And, I guess my view is that investors should always at least think about selling as a poor decision. And obviously, I think a good comment by Daniel, although I know that's a little bit tongue-in-cheek, is yes, there are, of course, reasons to sell. One reason to sell is that you are accessing the funds to retire. But we're talking about without any reason to sell, you're just selling an investment because you think it's not the best investment in the world or you see some other opportunity. So couple things that came out of a study that I talk about a lot that the University of California at Berkeley did. And what they did is they looked at retail brokerage activity. So these are, of course, American investors, but I think this has lessons for all investors. And the study actually came out, which I think I say somewhere down here later, study came out in like 97, 98. So it is important to use that context. But they looked at a couple different things. They looked at a lot of different things. But two of the things they looked at is they looked at obvious exchanges of one investment for another. So they looked at somebody's brokerage and, you sell something, then you go back right away and you buy something else. And they looked at what was sold and what was bought. And they looked at a number of different lengths of time. But after 504 trading days, what was sold outperformed what was purchased by 3.32%, which is a lot. Right. So that's one thing that we need to think, okay, a lot of these decisions that we're making, I'll sell this, I'll buy something else, is the wrong decision. We'll talk about why in a second, but that's one thing to look at. The other thing, of course, is people who sell a lot are also people who trade frequently. So it looked at investors and divided them up into quintiles based on how much they traded. So the investors that were trading the most, they had monthly turnover of their portfolio of 8.8%. So what that basically means is that close to 9% of their portfolio was new positions every single month. So that is a lot of trading. That basically means that you're turning over your entire portfolio and a little bit more every single year. So that is a lot of trading. And we have to remember the context that we're looking back. They looked at 6 years worth of data. They were doing this in the late 90s, and this was a very good time for markets. But the average return earned by traders who traded frequently was 11.4%. And those that traded infrequently, so that quintile that traded a lot less than everybody else in this study, earned a return of 18.5% per year. So obviously that's a big difference. And just so you know, that 18.5% slightly beat the overall market returns as measured by the S&P 500. So it shows you that people, even though 11.4% frankly sounds great, and I think a lot of investors would take that as a return, during that time period, that frequent trading was getting people a lot lower overall return. And there's a couple different reasons why selling is a bad idea, why you do need that hurdle to make sure. And of course, you're going to sell at certain periods, but a hurdle to hold you back from constantly selling things. So it leads to transaction costs and poor tax outcomes. And this survey, exactly, so Andrew just said it, this study that was done by the University of California didn't include transaction costs, and it didn't include, of course, tax outcomes because they didn't know of those individual investors. So that is actually going to lower that return even more. So that makes it even worse. The assumption is, of course, that there are better opportunities out there. So certainly there are cases where investors are going out there and they are selling things because they want to adjust the asset allocation in their portfolio. I want to have some more cash. Well, most likely these people that were trading and turning over their portfolio close to 9% a month were not going to cash, right? They were just looking for better opportunities and probably looking for better short-term opportunities. But often that's just an excuse to chase performance. So if you're selling a company that's not doing well, and it's already reflected in that security price, and you're buying a company that seemingly is doing well, and this is something that happens a lot during results season, right? A company will put out great results. You'll think, wow, that company's doing really well. Well, that's just chasing performance. And it ignores a couple different things. So it ignores this notion of reversion to the mean. And reversion to the mean simply says that there are periods of time where some companies, some indexes, everything else is outperforming and they are earning above average returns. And then eventually this will come back to average. And so, of course, if you're selling things that are not doing well and you are buying things that are doing well, you're really ignoring that. And the other thing, especially during earnings season, and I'll add a little bit more to this as well, is that markets react instantly. And they generally react faster than you can. So even if it's just at the open, if somebody reported results after the market closed the night before or before the market opened, you'll see swings right at the open. So By the time you log into your account and you actually go through the transaction, the results have probably already been captured in the share price. So sure, if something swings wildly, it would have been nice to know that the day before, but often it's very hard to react faster than the market. And then I'd say longer term, if you're looking at longer term, remember those expectations are built into that share price. So if everyone thinks a company is terrible and is not going to do well, well, that's reflected in the share price. And more importantly, if everyone thinks a company is great and is going to continue to do really well, that's also reflected in the share price. So even if the company does well, but misses those expectations, doesn't live up to those expectations, that can be a really poor outcome for investors. So what should you do thinking about selling? And we're going to talk a lot about structure in terms of buying. But what you should do, well, the first thing, of course, is before you actually purchase an investment, there should be a reason why you did this. And the reason can be, well, it should be grounded in what you're trying to accomplish, your investment strategy, the way you select securities. But writing down the thesis for a certain investment is also really, really helpful because it's something you can go back and revisit when you're trying to make a decision to sell. So I bought this company for these three reasons. And that means that you're not just reacting to how it's doing at the end of the day. So if you had three reasons why you bought a company and the share price just happens to be down, which triggers a lot of people into actually selling, well, you can go back and revisit that thesis and see if that thesis still stands. So just add some structure around that. But we'll talk about that on the buy side. But I wanted to go through selling first because I thought that was good. So Paul's asking, typically, how long is the increased volatility period? Well, generally just during that period of time where the results are coming out. So it's kind of the twofold effect. So number one, when we're looking at individual companies and we're talking about that volatility, so that of course would be around their earnings, but we also have to understand that during that whole period, competitors are reporting as well. Investors may go from, remember Ben Graham described the market as this kind of manic, sort of, well, personalize the market as kind of this manic creature that went from highs to lows. But you also have to remember that based on the collective results from companies, investors collectively can decide that they view things more optimistically or pessimistically, and that can increase volatility as well. So generally just during that month, you're seeing, in the case of Australia, you're seeing that month twice a year, you're seeing increased volatility. All right. So we're going to talk a little bit, and we won't go through all of these different pieces. We go through goals a lot, so we're not going to do that. We'll focus more on investment strategy and security selection. We want to put structure around everything we do as investors, right? Because we have to understand that we often behave irrationally, and we're never going to get rid of that entirely. We're never going to be completely rational investors, but the more structure and the more we can minimize those mistakes, right? When we act irrationally, that's generally when we're making investment mistakes. So the more we can limit those, the better. And so that's about putting this structure around buy decisions. And this structure allows us to, number one, hopefully be long-term investors, focusing on the long term. Once again, that is something that is a key to investing success. It means minimizing, of course, transaction costs. It means minimizing taxes, hopefully, as well. So that long-term approach is really important. A structure can help you do that. We also need to understand that each investment opportunity is not right for every investor. So obviously the way that a lot of investing is covered, and same way we cover it at Morningstar, is, we're looking for opportunities. Our analysts are looking for opportunities, but that doesn't mean that's necessarily right for you. Right. And part of being an investor and part of having the structure around the decisions that we make is trying to figure out, okay, what is the right way for my goals? And what's the right way for my temperament, the way that I think about the world, to go out there and invest? And one of the most famous examples of this, which he got ridiculed a lot for, was during the big tech run-up, during that period that the study took place, so particularly in the United States, in the 90s, during that huge tech run-up, Buffett, through Berkshire Hathaway, was underperforming the market. And he famously didn't buy tech shares. And so he received a lot of ridicule during that time period. Everyone said he's old, he's out of it, he doesn't understand the way the world works now. And he simply said, maybe that's true, but I just don't understand these investments. And he didn't understand the way that these investments were being described, and he didn't understand the criteria the market was using to go out there and select investments. And he sat out that whole tech frenzy, which at the time was really hard. Worked out pretty well for him. Of course, the NASDAQ went down 80% after the tech bubble burst. And it's actually the second time, interestingly enough, it's the second time in his career he did that when Buffett first started investing, I guess professionally, he had something called the Buffett Partnership, where he basically went out to a lot of his parents' wealthy friends and got money from them, and he was investing. And he did the same thing in the 60s. So the market in the 60s was going crazy as well. There's all this notion of the Nifty 50 and everything else. And Buffett at the time was a real value investor. He's changed over time, but he basically closed up the partnership and said, I don't really understand what's going on with the market. I don't understand the criteria that's being used to evaluate stocks. So I'm just going to stop doing this. And instead kept this little, not doing very well, mill called Berkshire Hathaway in New England. So anyway, just an example. And the third thing is that, yes, this notion that certain types of investments resonate with certain investors. And the reason that's important, and the reason why it's important to have this, I guess, intellectual attachment to not necessarily a company, but a style of investing, is because it makes it more likely that you're going to do that over the long term, right? So if you're just chasing whatever happens to be doing well, it's going to be very difficult for you to rationally assess that investment if things start to not do well. So it is important to have that intellectual alignment as well. So let's talk a little bit about this structure. And I use an ETF example in here, but the first thing is the notion of an investment policy statement. And an investment policy statement comes from professional investors. And basically, they have investment policy statements because there are rules that govern the way they invest. So very simply, if I am a Aussie equity manager and I invest in large cap Aussie shares, I can't go out and decide to buy Japanese shares one day. And that's really important, of course, because if I'm going to invest with that manager, I'm trying to get Aussie exposure. I don't want them to go pick Japanese shares. If I want Japanese shares, I'll go find someone who's investing in Japanese shares. So they have these structured mandates that talk about their investment strategy and approach in the universe of securities they're going to look at. And this is really the idea of having this for all investors. So having this for individual investors as well. And it doesn't take, you don't need some 50-page document governing the way you invest, but it's really just looking at what are your investment goals and objectives and what's this strategy, what's the approach you're going to take. And the approach can be very simple. Your approach could be, I am going to invest passively. And that's the approach I've decided to take. So instantly, what that at least does is it cuts back on all of this choice you have as investors. So you can just ignore things. So if you read the AFR and the AFR is talking about some great active manager, you can say, well, I can just ignore that piece of information because I invest passively. I've decided that's the way I'm going to do it. And just the example I looked at, and this is actually a little bit old data, because there are even more now. There's a lot of ETFs in Australia, just as an example. Well, how do I go through 287 ETFs and find what's right for me? Well, if I have a strategy that naturally narrows that down, then all of a sudden I have a smaller universe to look at. So what we're trying to do is we're going to make sure that we are not reactive, that we are not bouncing around to whatever happens to be hot. And instead we say, okay, I've got this universe, this sandbox that I'm going to play in, and that's what's going to govern the way that I actually invest. So it just makes sure that there's more thoughtfulness involved in any of those investment decisions that you're making. All right, so we're going to use an example of an IPS. And I'll get into, well, maybe I'll pause for a second here. See if I have a couple questions. So let me go through those before we get into the example. Yeah, Daniel says never sell. It just makes brokers money. That's true. That is true. It does make them money. So Gary says, what about selling or at least taking profits when prices reach historic resistance levels? Okay, so I think there's two different ways to think about this. And part of, and what we're getting into, it's a good segue actually into this first page. So as part of your IPS, we want to start with goals. I said we weren't going to go through goals today, but of course you need to know what your goal is. And we have a lot of webinars and a lot of material on going through goals. So we start with our goals. We won't spend much time on that today, but that allows us, of course, to come up with the return that we need to achieve our goals. And that, of course, allows us to look at asset allocation. Now, along with asset allocation, what you also want to do is you want to document how big of a position you will hold in each security. So what I'd say, Gary, is the first thing is it's perfectly rational if you have a system in place where you say that I will not allow a position to get more than 5% of my portfolio. And that can be a perfectly rational reason to sell. I'm buying individual shares. I don't want a position to be too big. So yes, I would take profits if that position grew larger than 5%. So I think that that's perfectly rational. In terms of historic resistance levels, the only thing that I'd say about that is that my worry would be that if you are getting into that mentality and it's not triggering something like becoming too big of a part of your portfolio, is that you are going to have really high transaction costs and tax as well. So I guess that would be my worry about that approach. And also a historic resistance level, like, yes, obviously we can go look at charts and we can see where shares tend to bounce between. But that, of course, doesn't mean that those are not broken through at certain times. So if it is something that you're still confident in, if it is something that you are looking to hold for the long term, I'd just be wary of using that historic resistance level as a reason to sell. And one thing I'd add to that as well is sort of my personal opinion is that we, of course, provide valuations on shares that our analysts cover. And a lot of people always ask me, okay, so I understand if something is undervalued, if it's a 4 or 5 star stock, I understand that, hey, maybe that's a good opportunity to get in, but do I sell if it gets to a 2-star stock? My argument would be no. That, as investors, we have to naturally understand that prices of things that we own are going to go up and they are going to go down at different phases. And we just have to accept that. And that the outcomes, whether that's a tax outcome, transaction costs, moving your money to something that does worse, that all of those bad outcomes that come from selling, maybe it's better, even if that share price is going to fall a little bit. If you're still holding it for the long term, who cares? It's better to just keep things. So that's my personal approach. But yeah, that's just me. So Daniel says, goal, retire with as much as possible. Strategy, long-term investing in low-cost ETFs with a select few managed funds for small cap security selection. All right. Daniel will never buy an individual equity in my life. And I think that that's a perfectly sound strategy. So yeah, thank you for sharing that. And Rodney says, I understand the Morningstar Mark is not necessarily a fan of the retire with as much as possible goal, as opposed to specific target goal, like you need X amount of money. However, I find it hard to actually specify the dollars myself, which does make it difficult. It does. So let me talk a little bit about this for a second, Rodney, because you brought it up. So it's sort of this idea around wealth maximization. And if you go out there and you tell somebody, all right, you need to set a goal, they will come back and they will say, my goal is to have as much money as possible. And honestly, that's probably all of our goals, right? I think most people that are out there investing want more money. That's why they're doing it. But the issue is, I think, how that actually impacts your behavior is if you want the most money possible, then a lot of people naturally take that and start thinking about, okay, I need to be in the best performing investments all the time. And so what that means is that if I pick up the AFR and the AFR says, like everybody was saying, by the way, like 6 months ago, oh, buy Chinese stocks, they are going to do really, really well, which incidentally, they haven't. China's a bit of a mess right now economically. But if that is your goal, you have the natural tendency to say, okay, well, all these smart people are saying buy Chinese shares. All right, well, I guess I should sell all my Aussie shares because people are saying that's going to outperform the Australian market. And so my worry is that if you have this, I need as much money as possible, you are going to get into that chasing performance approach to things. And it can be very hard to define how much money is quote unquote enough. But what I'd also say is if you say that I need, I'll make up, if you say I need $100,000 in my account and that is my goal, there's nothing stopping you from having more money. What it's actually doing is it is hopefully giving structure to the way you think about investments. It's not holding you back from actually getting more money than that. So I guess I would just say what it's trying to do is it's trying to induce good behavior. It's not trying to limit you to some sort of worse outcome. So I guess that would just be my argument. Maybe it's just a mental trick you're playing on yourself, but people do that all the time. Let's see, what else do we have on here? Oh, I think people are just talking to each other, which is good. All right, well, that is good. Okay, so let's go. Let's go back to this investment policy statement. So as I said, yeah, all we're doing simply at the beginning, got a goal, come up with an asset allocation we're trying to achieve that, of course, will help you achieve that return that you need. And then we get into the interesting part, at least hopefully the interesting part. So I put mine in here just because, I don't know, I figured it was better to share an example. It's a little more thought through than this, but this is sort of high level. So, and this is talking about what are the things that I think personally match the approach that I'm going to take. So as I talked about in some articles and some other things, there is a little bit of an emphasis on dividends for my taxable accounts, so stuff that's not in a retirement account. So really what I'm looking for is low business risk companies, and we'll go through an example in a second. Low business risk companies that pay dividends at a rate that's higher than average, that I think are reasonable from a valuation perspective, and we'll talk through all of this, and that the hope is that this will limit volatility in my portfolio and also limit dividend volatility as well. So part of this is just based on my personal circumstances that I am using dividends to pay for certain things in my life right now. And so really limiting that volatility with that income as well is something that's important. It's also really important to think about, okay, what is your investing edge? And edge, of course, just refers to what is your competitive advantage. So certainly, if you're going out there and picking individual shares, you should have in your head why that is a good strategy, why you are not taking the market return and just investing passively, because you are saying that for some reason, it's not necessarily just to beat the market. It could be to get some other investment outcome, like lowering volatility, like getting higher dividends. But you should have something in your head why this is a good approach for you to take. And I would say this is not just for people that are picking individual shares, but if you're going out there and you're using active managers, if you're going out there and you are investing, even if you're investing passively, but you're investing passively in a way that is different than the overall market, as in you're allocating more money to, let's say, small caps, You're allocating more money to certain countries or regions. Even if you're using passive products, you still should have some sort of reason why you're doing this and what that edge is you have over other investors, because ultimately we want to achieve our goals. And if we're looking at trying to beat the market, or we're making a decision to go out there and essentially say we're trying to beat the market, then we should understand why we will do better than average. And so when I think about myself, and there's really four sources of edge here, there's informational edge. So that means you know something that other people don't, which is very difficult nowadays. So like you know information that other people don't. A lot of that's insider trading, which is a good edge to have. But a lot of this has gone away. Right? It's gone away just with the internet and the ability to sort of instantly access and disseminate information to everyone. So I don't think I have an informational edge. I don't think I'm privy to any information that nobody else is. There's an analytical edge. So that means I can take information that is widely available, but I can interpret it better than most people. So it means I can go out there and look at a company, read the same financial statements as everyone else, but that I can make a better decision off of that information than most people. I don't think that I have that. And then there's behavioral edge and structural edge. And that's kind of the two places where I think that hopefully I can have an advantage. And really behavioral edge, more than anything, is not doing dumb things. So it's really limiting those mistakes that hold us back. And as I've talked about in here, one of the ways to do that is through structure. Having a plan, executing that plan, being consistent. So that's one place that I think I have an edge. And then sort of the structural edge as well. And being a long-term investor, because most people aren't. Most professionals aren't. Most individuals aren't. I believe that, well, I think there's a lot of data that actually shows it, that being a long-term investor, minimizing, once again, when we're talking about returns, which are after tax, after transaction costs, when we're looking at returns, well, one thing, as that study showed, is trading less is better. Being a long-term investor and holding things for very long periods of time and actually compounding as much as possible is a really good decision. So those are kind of the two places that I see edge, right? So at the end of the day, this is nothing really about stock picking. What it is about is not making mistakes and not responding to volatility. And then kind of when we look at investment criteria that naturally flows down here. So ETFs that have a focus on quality. So we talked about quality in terms of the companies that they're investing in. So once again, that kind of means low debt. For one thing, it means potentially companies that have moats. There's all sorts of kind of quality criteria that we can use. Income. So this should say, I really do know English, it should say income producing shares, and sort of things that I look for because it resonates with me. Once again, there are lots of different ways to invest successfully. I'm just trying to find ones that I have this intellectual connection with so that I can be a long-term investor and so that I can stop myself from going out there and chasing returns and selling all the time. And it's companies that are non-cyclical. So their earnings typically don't follow the economic cycles. They do really well and the economy is doing really well, do really poorly. So I'm sort of naturally drawn to things in healthcare, consumer defensive, things like that are non-cyclical. Not a big fan of debt. It just adds risk to companies. It causes management to make poor decisions, can cover up a lot of stuff in the short term. So companies with low debt, talked about high dividends, and of course, moats. So companies that have that sustainable competitive advantage that over the long term will accrue to shareholders, right? So if you are a short-term trader, if you're one of these people that's turning over your portfolio, 9% per month, you shouldn't care about moats because they're really not going to make any difference in how a company performs over the next month, right? But the hope is over years and years and years, things like high margins, keeping more of everything that we sell, high returns on invested capital, meaning that when the company goes out there and invests in a new project, that they will earn high returns on that. Those things over the long term accrue to investors. So it's really trying to marry all of this up. So, kind of the strategy that helps me achieve my goal, the edge that I think I have as an investor, then of course that criteria. So I'm selecting investments that fit into that, right? So, and this is obviously a little bit of a outlier, but I wouldn't go buy Bitcoin because Bitcoin doesn't fit into this at all. And I'm not saying, at least right now, that Bitcoin is a bad investment. I'll just hold my thoughts keep my thoughts to myself on that one. But I wouldn't go out and buy Bitcoin because it doesn't fit into any of this, right? Like it is not something that pays a dividend. I can't earn anything from that. It just doesn't fit into my strategy. So that's not something I would ever go out there and buy. So that's really allows me to narrow down that universe of what I'd go out there and purchase. So I'm going to use an example. And once again, I did buy CSL like a couple of weeks ago. This is not certainly an endorsement for anyone to go out there and do this. I was just using this as an example. And really, when we talk about earnings season, we talk about that volatility that we see. And I did buy CSL before earnings season. But one of the things, of course, we need to do is we need to have a watch list or securities that fit your criteria that for whatever reason, and price can be a big reason, valuation can be a big reason, are not something that you go out there and buy today. But the ability to have that watch list and going into a period like earnings season with a watch list is maybe something that's on there will turn into an opportunity for you based on price changes. It's very hard to be reactive, to have no list of companies that you want to own if you're investing in individual shares and walk into a period like earnings season and try to react to how the share market's reacted to a company's results. Of course, all the talk around that company. It's very hard to do that. Just like it's very hard if we fall into a bear market and the market goes down significantly. There's a lot of noise out there. It's very hard to react. But if you have a list and a plan saying, okay, even if I'm investing in passive ETFs, I want to up my equity allocation in the following way, then of course you can react to things where there is volatility, in that case over the whole market. So let's go through CSL. So what I listed is some business criteria or some criteria that I had put in there of companies I would like to buy and sort of how CSL ranks against them. So the first thing is business risk. Now, business risk, and I said I wanted low risk companies. So business risk, of course, refers to the fact that we are buying businesses, and forget the share price, but different businesses have different levels of risk. So larger companies generally have less business risk than smaller companies because they're more established. So that's just an example. There's all sorts of examples around this, but our analysts write about business risk in all of their reports, and they actually rate companies. It's called risk and uncertainty. So a company with high debt would have more risk and uncertainty than a company with low debt, right? Because, of course, debt is a burden that companies have to deal with. And if things go south, you'd rather have less debt than more debt, right? So, and that doesn't mean everyone should invest this way. The opportunity set, right, the business outcomes of something that's very, very uncertain, there's probably a lot more upside and a lot more downside in those. And some people are very comfortable with that as an approach to investing. I'm personally not. So I'm looking for low business risk companies. So really, if you go look at the risk and uncertainty area in our analyst report, they view it as unlikely that any sort of innovation is going to impact the plasma industry. So they don't see some magic new treatment approach that's going to upend the entire industry. They believe that CSL, which controls a lot of the plasma collection in clinics that they own, is, of course, a good thing in terms of stability, right? They're controlling, of course, their whole kind of production line, if we want to call it, versus relying on somebody else who could charge higher prices, who could do all sorts of things. How much we have control over our supply chain matters. They also think that it gives a cost advantage to CSL. And the fact that this industry is dominated by three companies, and three relatively big companies creates high barriers to entry. So we can spend a second on this. Everyone always likes to talk about these new and emerging technologies, whatever else we want to call it. The problem is that when something is supposed to grow significantly and is very, very early on as a business, of course, there's lots and lots of competitors. And it becomes very difficult for us as investors to pick the winners. And so I was listening to a podcast this morning that was talking about search. And Google obviously dominates search at this point. But when search first came out, there were all sorts of different companies out there with search capabilities, right? Most of them are gone. And the ones that aren't gone, like Yahoo, don't have very high market share. So an investor back then, even recognizing how important search would be, it's difficult to pick those winners. So if you pick more mature industries where you have a larger market share, that lowers the business risk. So that's what our analysts think about CSL. So they actually assign it a medium business risk, so risk and uncertainty rating. So that certainly fits into my criteria. And even though medium sounds like it's in the middle, it's not really. So we have extreme as the top risk and uncertainty rating. So it's actually the second from the bottom, and there's more on top of it. So dividend. So as many people that know CSL know that CSL actually has a pretty low dividend yield. So I think it's around 1.25% right now. So that is significantly below the market. So I will say that it does not fit that criteria. But in terms of a yield, that's one aspect, of course, of being an income investor. The other aspect is, of course, growth of that dividend. So if we go back and we look at the last 7 years, and I probably could have gone back further, but I was lazy and didn't want to calculate it, it's grown at an average of 11% per year over that period. So that is good growth. Our analysts, of course, forecast out dividends into the future. So the next 2 years, got a forecast of around 12% first year, and then around 19% in terms of dividend growth. So that growth eventually will make up for that low yield. So that's why I was comfortable actually going out there buying that. Cyclicality, well, it's a healthcare share. So generally, healthcare is something that doesn't have a lot of cyclicality. So if the economy's not doing great, you're probably still going to go treat whatever disease you have. So that's sort of the last place that people will cut. They'll spend money on food. They'll spend money on healthcare. So a lot of those consumer defensive and healthcare companies have very low cyclicality. Debt. So debt is part of our capital allocation rating. And it's exemplary, which is our highest level for CSL. And the company carries pretty little debt. And the fact that it's in a cyclical industry, of course, and there isn't that earnings volatility, means it's a lot easier to carry debt, but the company has very little debt. And then, of course, moat. So it has a narrow moat rating by our analysts. So that means that sustainable competitive advantage we believe will be maintained for at least 10 years. And cost advantage, as we talked about, by controlling the plasma collection that they do, and intangible assets. So a lot of intangible assets is around the intellectual capital that the company's built up around creating plasma-based treatments, and is reflected, of course, in their ability to continue to create new treatments on top of that, is why there's a moat. And we can see return on invested capital, so 19%, which is very good. So that's what they have. That's what they've delivered in the past, and our analysts expect that to continue. And then operating margin, I did see a question come through, which I'll read fully in a second, but operating margin is 16% at this point, but we do expect it to increase. And I can talk a little bit about what's happened with that operating margin in a second, but certainly a case where analysts think that is very strong. Let me go through one more slide, and then I'll get to some of these questions. So a couple of things that I copied out. So just so you can see is basically, and we can talk, and the question was about why CSL dipped. So this is the last 5 years. You can see obviously a huge run up. But then the price has retreated significantly. And if we go and we look at our price to fair value, which represents the price and what our analyst thinks it's worth. So you can see over here, their analyst thinks it's worth $330 a share. So yeah, it closed last night at 266. And really where I got in was just a little bit below that, which represents a price to fair value of 0.8. So really a 20% discount. And if we go back and we look at historically, it has generally, for most of the time, saw back in 2016, but most of the time, as you can see, been something we considered overvalued. So there was that pullback. And interestingly, a lot of that pullback, and I guess just to talk about CSL and some of the issues they've gone through is, number one, COVID was not a great time for them because it did make it difficult to, of course, collect plasma because nobody wanted to leave their house or couldn't leave their house to go out and give donations. So at these clinics they control. And what that did is that certainly squeezed their margins. It became a lot costlier for them to go out there and get plasma. Our analysts see that largely disappearing, for one thing. And then, of course, this sort of drop is they pre-reported that there were some currency impacts to their profitability. And the share price actually bounced a little bit after they actually reported their earnings. But I just saw this as something very temporary. My goal is to hold this for a very long time. And that currency obviously is always going to be something that's going to fluctuate. There's going to be good periods and bad periods. And that is, and that certainly, that dip I saw as an opportunity to actually get into something that I've been looking at for a while, but thought was attractive and looking at because I thought it met my criteria, which of course only makes it something appropriate for me. But anyway, let me get to some of the questions. Let's see. Well, this is a very long one. Well, that's a comment to someone else, so that's easy. So Phil says, you may have already mentioned this, Mark, but if your goal is income and you maintain a maximum position of, say, 5% stock, how do you reconcile rebalancing to maintain the 5% limit when a particular stock price is shooting out the lights? Yeah. So, what I would say personally is, there are kind of two sides to this. So when the accounts that I have that are more income focused, so I look at one, sort of the position sizing. And I also look at the amount of income, total income I'm generating and how much each security generates. So I don't want either of those ideally to be more than 5%. I am very reluctant to sell. And so what I try to do as much as possible is, one, not purchase something so that it's up close to that 5%. So even if I say that's my limit, I wouldn't go out there and buy a 4.75% position, right? I don't want to go out there and buy something that actually does well and then be forced to sell it immediately. So I think it's about position sizing at the beginning. And then it's also, what are the other ways that we can rebalance our portfolio without actually selling? And one of those things is investing more money. So saving and investing more money. And this is very, very dependent, obviously, upon your personal situation. I still, despite the way that Emily and everyone else thinks of me, I still will be working for a while. I am still saving and investing. So I am still adding money to my portfolio. That could be very different, of course, if you're retired. The only thing I'd say is that if you are retired, of course, there are sort of natural ways to limit those position sizes because you're most likely selling to meet those super withdrawal requirements that you're under. So it's a little bit different. So I try not to get into that position. And as I get to a place where a position is approaching is approaching, my computer's going to run out of battery, so excuse me. As it's approaching that limit, there are things you can do like turn off a dividend reinvestment, take those dividends and reinvest them into something else. So those are some different approaches that you can take. Hewlett Packard got trumped by someone they didn't listen to, who went to form Taiwan Semiconductor and create the potential World War III situation we are in today. That may change anything altogether. Yeah, like, listen, what I would say is that there are hundreds of cases, of course, of companies that seem very, very solid that then don't work out, and that's why we diversify. And yeah, I think the HP and Taiwan Semiconductor is an interesting one. Kodak, I think, is like the classic case study that Kodak invented digital cameras and then thought, okay, well, this isn't really going to help our business of selling film, so we won't do anything with that. And of course, then film went away. So yeah, no, it's a good example, but that's why we diversify, right? So anything, of course, can happen. So Gary says I bought CSL as 20% discount. We'd be looking to sell when it reaches Morningstar fair value. I guess I struggle to hold it if it's considered overvalued unless Morningstar re-rate it. Yeah, I mean, fair enough. I think it's just based on your tax situation, and yeah, how much you are actually going to have to pay in taxes and transaction costs and everything else. So Rod says your 5% allocation influenced by market weight. How do you allocate for an ETF? Okay, so sorry, I should have explained that. So that is only for individual shares. So in ETF allocation, I would take a much higher position, of course, because that is naturally diversified. And the whole point of that 5% is simply to diversify out of single security risk, which you don't have if you're in an ETF. So basically what I'm trying to diversify away, and there's a lot of different reasons people diversify and a lot of confusion, frankly, around diversification. I am doing that to avoid single security risk. So that is the risk that, one, that I'm wrong, which happens all the time. Two, that, God forbid, management makes incredibly stupid decisions. There are cases where management commits outright fraud. So just trying to diversify away that single security risk. So that would not be the case with an ETF. I would never limit a sort of wide index ETF to 5% of my portfolio. And Gary says, especially when CSL's dividends aren't very high. Yeah, like a lot of people use dividends, of course, it's a reason to hold something, because even if, of course, the share price isn't performing well, you're still getting that dividend. So yeah, let's see. Rodney's saying he's talking about the maximum dollars leads to return chasing. I guess the issue is specifying a X amount that isn't just based off the net assets we already have, and working forward from that using an assumed rate of return, probably because we're actually much closer to retirement, so can see the goal. Yeah, I mean, listen, it's none of the approaches that we take are maybe absolutely perfect. But even if you are closer to retirement, yeah, as you said, it's probably easier to come up with that actual goal. And then perhaps, depending upon where you are close to that goal, maybe trying to maximize your returns is not the safe thing to do, because instead you're trying to limit volatility in your portfolio. Maybe it's building up more cash. Yeah, so Andrew says, do you have any thoughts on buy behavior similar to your sell side during earnings season? Yeah, I think in many ways, the buy behavior is pretty similar to the sell behavior at the end of the day. So I think what people tend to do during earnings season is, of course, become enamored with the results that somebody puts out there, and potentially become enamored, and what I've sort of seen in the past, they become enamored with results that maybe they don't necessarily understand the implications of. And the example that's going through my head is, every time the buy now, pay later companies were reporting, you would see these crazy numbers. Oh, we've grown by 200%, revenues up 200%, blah, 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 all this stuff. And I think that people can become overly enamored with that, and that is the rationalization of why people are going out there and buying things. And we have to remember that, number one, of course, the press releases that come out from companies are written by PR people. Of course, they're trying to make things sound good. And that, I think the financial media, particularly with growth, right? We're so enamored with growth as investors, particularly with growth, can just sit there and gush over these growth stories and these new technology stories, biotech, and all the stuff that we're all really into. So what are we into now? We're into AI, right? So everyone's talking about AI in every single release, even if they don't do anything with AI. And so I think that that's the problem as well, right? That, we are getting this sort of reinforcing loop that's feeding into sort of our natural greed tendency as people. So I think it's the same thing. It's kind of that emotional response, and some emotional response that also is validated, right? It can be validated when share prices jump. So, if you saw Zip reporting earnings 4 years ago or whenever, and then all of a sudden you saw this huge jump in the share price, that just sort of feeds into this tendency for us to chase things. And that's why we just have to remember, just like with shares falling after earnings release, that share price jump you've missed most likely. So if Zip reports earnings and share price goes up by 20%, that may have been great to know yesterday, but you've missed that jump. And what does that 20% jump mean? Well, it means that expectations are just so much higher for the future. And it's easy to pick on the buy now, pay later companies at this point, certainly. But yeah, I think that's the issue. So Timothy says, what's your view on subscribing to DRIPs? I personally like them. There's a lot of arguments against them, and basically the big arguments, asset dividend reinvestment plan. I know we're running out of time, but the reason that I like them is because, of course, as you're trying to grow income, for example, or you're trying to build exposure to a position, of course, you're getting shares for quote unquote free, right? So that's the part that I like about them, is that I see my income growing over time as I own more shares. The reason, and I agree with this, I just like them. The reason why people say that you shouldn't use a DRIP is because that is making that capital allocation decision for you, right? That the best thing to do is actually, all right, well, collect all your dividends in cash, and then go out there and find the best opportunity to invest them in. But that, of course, assumes that you can always make that decision, finding that best opportunity, where it's not like an index, but in a way, it's like an index of your own portfolio that you're just steadily increasing everything. So you're not making that decision. So it's, once again, probably a little bit of a mind trick. But anyway, yes, I do like them. All right. Well, we ran out of time, which I guess is good. We're doing a webinar tonight on something to do with retirement. Yes, preparing your portfolio for retirement. So if anyone wants to swing by virtually at 6 o'clock, or you can come sit in the room with me, you can do that. So thank you guys very much for joining.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.